We go to chapter 25, economic growth. Quickly go to the, okay. So what is macroeconomics? It says macroeconomics, in an economy, when you talk about economic growth, we're talking about the activities within the economy in terms of its output, in terms of export, in terms of imports. Are you there? Okay. So whatever activity the business does, this is what we measure in terms of its growth. So the economy is going to produce output in terms of goods and services. The economy is going to have trade transactions with other countries. All these things, if the country is doing well, if the economy is doing well, then we consider that the economy is growing. So for economics, we have macroeconomics and micro. So what's the difference between macroeconomics and microeconomics? Here they said microeconomics is for microeconomics said one of these involves looking at the economy as a whole. It looks at the performance, structure, and behavior of the entire economy. We talked about that already. So when you are analyzing the total income or spending or the total employment, the general price level and the total value of all goods traded within the countries, this is macro. So for macroeconomics, we're talking about the total of what happens in terms of goods production, in terms of production of goods, in terms of provision of services. So whatever happens within that economy, demand and supply, is macro. But for micro, they said micro is just the individuals. It's the study of the individual part of the economy. So here they said microeconomics looks at individual parts of the economy. It looks at how individual households or firms make decisions when allocating resources. When we think about total demand in the economy, total supply in the economy, we're thinking about macroeconomics. But when you are thinking about the individuals in the economy, how the individual takes or decide in terms of allocation of resources, how firms or businesses decide in terms of allocation of resources, we call it microeconomics. Do you understand the difference between macro and micro now? Macro is the total dealings within the economy in terms of supply, demand. For the total, the aggregate demand in the economy is macro. Aggregate demand, aggregate supply in the economy is macro. That means you are looking at the economy as a whole. That is macro. But when you are looking at individuals, when you are looking at firms in the economy, it is micro. I think it's clear. Okay. So what are macroeconomic objectives? So here they say when managing the economy, the government has certain aims. So we're talking about the aims of government in the economy. So what are the macroeconomic objectives? Number one, redistribution of income, reducing unemployment, protect environment, balance of payments, economic growth, controlling inflation. So I'm going to take it one at a time. So I'm going to explain everyone at a time. So let's start with redistribution of income. So when you talk about redistribution of income, income is the amount of money that comes into the amount of money individual makes. So when you are talking about redistribution, the government is trying. It is macroeconomic objective are government objectives. So what the government is trying to do in an economy, that is what macroeconomics is. So what is the government of Libya trying to do? What are the objectives of government of Libya? That is what we want to talk about. So the first one is redistribution of income. So when I talk about redistribution of income, government wants to try to reduce the gap between the rich and the poor. That is how government redistributes income. Do you get the point? Government wants to reduce the gap between the rich and the poor. So how will government do this? Government can do this through taxation or increasing income. So government might increase taxation of wealthy people and reduce taxation of average people or increase income level of the society. So this is how government will try to reduce the gap between the rich and the poor. That is the distribution of income. I think it's clear. Then the next one, for inflation, I'm scrolling down please, page 196 now, with inflation. Yeah, for inflation. What is inflation? Inflation is a persistent rise. Okay. Inflation is a persistent rise in the prices of goods and services within an economy. So Another government objective or macroeconomic objective is inflation. And when you talk about inflation, inflation is a persistent rise in the prices of goods and services within the economy. So government, what do government want to do? Government wants to ensure that inflation is at the minimum level. There's no way we can do without inflation, because without inflation, businesses would not make profits. Without inflation, businesses would not make profits. So what will government do? Government will only ensure that inflation is reduced to the minimum. What are the effects of inflation? With inflation, prices of goods becomes higher. Consumers won't be able to afford goods and services. And if consumers are not able to afford goods and services, their standard of living will reduce. So government wants to ensure that people are doing well. The standard of living in an economy, the standard of living in such country is increasing. So inflation, that means the prices of goods and services can be an hindrance to a better living standard. So government wants to ensure that inflation reduces in the economy. Okay, here they said, checking government economy, okay. Go back to see. Okay, measuring economic growth. All right, I will just take you through this way. So for measuring economic growth, you measure the growth of an economy through the gross domestic product. What is the GDP? GDP is the measurement of the total output of an economy. That means the monetary value of what this country has produced in terms of goods and services, import and export. So the GDP of an economy shows the value of the amount of money that an economy has made. That is what GDP is, gross domestic product. That means you would have gotten your PPC. Your PPC is the production possibility curve. That is the total of goods produced in the economy. So you sell these goods out, right? What comes back to you is a measurement of what you have sold, which is the GDP. So GDP is the measurement of your PPP or PPC. Is it clear? So you can measure an economic growth through the GDP. Now we go to inflation. I just explained the inflation now. Then population changes. Population growth must be taken into account when analyzing growth patterns. For example, if GDP grows by 2.8% in a year, and the population also rises, this increases in population will offset the growth in GDP. So GDP will therefore be difficult to calculate. To overcome this problem, changes in GDP per head or per capita can be calculated. So another method of calculating the growth of an economy is through the GDP, through population changes. That means we want to know the GDP per capita. The formula for GDP per capita is GDP divided by the number of people in that country. The formula for GDP per capita is GDP divided by the total number of people in that economy. That is the total population. That's how they calculate the GDP. So if the population is increasing and the GDP of a country is reducing, then there's a problem in that economy. So as population increases, the GDP should increase. That means the level of output produced in that country is also rising. Because we should see it as when population increases, workforce will increase. Then as a result, output should increase. But if it is the way it's opposite, then there's a problem in that economy. The economy is not doing well. Statistical error. Here they said, gathering the data needed to calculate national income is a huge task. The government collects millions of documents from firms, individuals, and other organizations. Unfortunately, errors are made because information has been entered inaccurately or left out. Therefore, the true value of GDP is never really known. Another problem we could encounter when we're trying to measure the GDP of a country are based on the information we get. Governments are in charge of these things, but when they are collecting figures, they might have made mistakes in the collation. So if they make mistakes in collating the figures, then the GDP or whatever the growth of the economy would not have an accurate figure. So statistical error could influence the figure we get in terms of measuring the growth of our economy. Statistical error could occur when we misplace information or when we forget to put certain information. That's figures. You know, they are figures. So these figures, maybe you want to write 10,500, you go to 10,050. So it will not make the figure to balance. So these are statistical error. It could affect the measurement of economic growth. The value of own produced goods. Some goods and services are not traded and therefore economic activity is not recorded. Examples might include people growing their own produce or gardens. This is what we call sustenance, or what we call it. They call it when I remember, I'll tell you. But here, when you are calculating your GDP, you have to put into consideration the number, what you are producing in this country, what you're producing in this country that you're not sending out. Because when you are calculating the GDP, you have to think about exports. So if you are producing and you're not exporting, then it is difficult for you to make money from it. You are producing just for your consumption. Do you get what we're saying about it? They said the value of own produced goods. That means the value of what is being produced in this country that is not exported. So you have to put it into consideration when you are measuring your GDP.
Do they measure the goods that are made and produced in the home country but exported out?
Exported out. Yeah, that is where you get your GDP. But if you are only producing in this country and you are consuming it in this country, it cannot be used to measure. It will be considered as economic growth because you're only producing for your own consumption. The hidden economy, they say sometimes paid work goes unrecorded. For example, a friend may drive a family to an airport for $25 cash. This $25 will not be recorded. The transaction becomes part of hidden black or informal economy. Certain paid services go unrecorded in this way. People may do a variety of jobs for cash and not recorded transactions. Another problem we have when we are measuring GDP is that there are some transactions that will be done that is not recorded. Like you giving your friend something and paying you for it. It doesn't go to the account of the economy. It doesn't go to, government does not know about it. It's a transaction between you and your friend. So it is not recorded. It doesn't have any receipt. It doesn't have any invoice. You're not paying tax on it. So government will not have it recorded. So it is called hidden economy. Transactions that will pass the backstage in the economy is called hidden. So that means we don't know what happens. No record for it. Government does not know that you took your brother to the airport and he pays you for the taxi fare. Those things, they are transactions, but they are not recorded. But money is in exchange, money is involved. Do you understand? So that's what we call hidden economy. Things that we do that does not reflect on government accounts. Is that clear? Then we have GDP and living standards. For GDP and living standards, they said GDP is used to measure living standards. However, just because GDP rises, it does not automatically mean that living standards are also rising. Other factors have to be taken into account, such as, so if the GDP of an economy, we said GDP is the measurement in terms of output. Are you with me, please? The measurement in terms of output a country has produced. The GDP of a country can increase, but at the same time, the standard of living falling. So a country can witness a growth in its GDP, and at the same time, measuring or witnessing a fall in the living standard. That means how people live in that economy is falling, but the country is making money. So why would such situation occur? So that means there are other things you need to put into consideration when you are measuring the GDP and the living standards. So those things are one, the amount of leisure time people have. The amount of leisure time people have. So how much do people spend? How much time do people spend out of work? It's also what can determine the living standard, not just how much the country is making. How many people in that, what is the percentage of those who have the opportunity to take time off work? That's what they're talking about here. Two, the way extra income is shared between the population. What is extra income? Income that comes aside your normal income. Like, oh, I'm having a private class. It's an extra income. So how does this extra income be shared among the population? So do people really have extra income or not? That is what the point is saying. Whether growth has resulted in pollution or not. So that's an environmental factor. You have to think about what this country is producing. Is during the course of production in this country, do we have more pollution or not? are what we produce in this country not increasing pollution in the country? Because if it does, then the country is not going well. So we should, because we are thinking of how to reduce global warming, how to reduce pollution, how to make the environment friendly. So if we have to make the environment friendly, we have to start thinking about how to reduce pollution. So if our economic growth is attached to pollution, then we're not doing well. Do you understand? Do you get the point here? So economic growth must not be attached to destroying the environment. That is the point. And the last one, the quality of goods and services. So what kind of goods are being provided in this country? What type of services, what types of goods are being produced in this country? What type of services are being rendered in this country? Are they of quality? If they are of quality, then the standard of living of the country will be fine. So these are things you have to put into consideration when you are measuring the GDP and the living standard. Because all these things are part of our living standard. How the environment is like is a living standard. What kind of goods do we consume? What kind of services do we get in this country is part of our living standard. The amount of time we have to be off work is part of our living standard. If you are not rich, you wouldn't have time to be off work. Is it clear? So go to external cost here. He said, GDP does not take into account, these are the problems about GDP. GDP does not take into account external costs such as environmental cost, such as environmental cost. The country is producing, yes. Oh, the country's GDP is increasing. That means the country is doing well. But the country, people, when we are measuring the GDP, we wouldn't talk about the problems the country has faced in terms of external cost. The quantity or the percentage of people that has been affected with that production, we wouldn't put that into consideration. They will only say the country is doing well, but they will put into consideration those that the growth has really affected. Just an example of this World Cup in Qatar. When they were building the stadium, when they were planning for the Mundial, when they were planning for the tournament, they had to build different stadia. But in the course of building those stadia, a lot of people would have lost their lives. These things will not be put into consideration. So if the GDP of Qatar rises, we will only talk about the figures. We won't talk about the external cost that has occurred during this growth. Do you get it?
Yes.
All right. So this is what we call business cycle. So for business cycle, what is a business cycle? Business cycle is just the stage at which an economy will witness boom to recession and back to boom. Do you get it? An economy will witness growth. Afterwards, it will witness recession and it will come back to growth. That is what business cycle or economic cycle, it's a cycle. So what the country will witness in terms of growth, in terms of recession, back to growth. That's what we call economic cycle. Is it clear? So they said boom is the peak cycle, is the peak cycle when the economy is at the peak, is at the highest. The economy is witnessing the highest growth possible. That's boom. Then we have downturn. They said the boom will be followed by a downturn. The economy is still going, but at a slower rate. For downturn, it means that the economy is not going down, but the rate of growth is slowing. So it's crawling. It's not like how it used to evolve. So now the economy is growing, but not the same rate as it used to grow. That is downturn. So after downturn, we have recession or depression. At recession, it means the economy situation is going down. So after recession, if the economic situation is going down, that means economic activities in that country is falling. There will be high rate of unemployment. There will be less. The aggregate demand will fall. That means purchasing power will less. People will not have job. Living standard will fall. All these things are what we call recession or depression. After that, the economy will try to recover. That is recovery. You see recovery there. So the economy is trying to get back to what it used to be. That is recovery. After recovery, then there will be growth again. So this is how the cycle goes, from boom to downturn, from downturn to recession or depression, from recession to growth. Is it clear? That is the cycle of economy. So we go down to impact, the impact of economic growth. So if an economy is growing, what are the impacts? How does it positively affect the economy as a whole? One, employment. If an economy is growing, employment opportunity will increase in such economy. Because at that point in time, a lot of businesses will be making a lot of money. They will be selling. As a result, they would want to increase their output due to the increasing demand of customers. Do you get the point? Employment will rise if an economy is growing, because an economy is growing due to the fact that the economy is with the businesses in that economy are witnessing increase in sales. The demand in that economy is increasing. So if the demand in the economy is increasing, businesses would have to increase their output to meet up with the demand of the economy. Yes or no? So as a result, they might need to employ more workers. That is how economic growth will impact employment. Is it clear? Standards of living. If the economy is growing, the living standard will rise because a lot of people will be able to afford whatever they need to buy. You understand?
Yeah.
So economic growth will mean that I have a job. And because I have a job, I'll be able to afford those things I want to buy. Is it clear? Standard living will increase. Poverty. How does economic growth affect poverty? If the economy is growing, the percentage of people living in poverty will fall. Poverty means lack of basic needs. You not being able to afford the basic needs like food, clothing, and shelter. That is poverty. But in an economy, if an economy is growing, poverty level will fall. Is it clear? Now we go to productive potential. When we talk about productive potential, we're talking about the production possibility curve. So here they said economic growth can raise the productive potential of a country. This means that a country can produce more goods and services. So from PPC 1 to PPC 2 is just economic growth. That is what it means. So that means the country is able to use its resources to the fullest. Efficiency use of resources. And if there's efficiency use of resources, the economy will grow. Then the production possibility curve will shift outward from PPC 1 to PPC 2. I think it's clear. Inflation is another factor. So for inflation, we said if economic growth is too fast, the economy may overeat. This can cause inflation. If the economy is going too fast, how will the economy become overeat? This is the situation. If the economy is growing, people have jobs. A lot of people have jobs, right? As a result, the demand in the economy will rise. People want to buy everything they want to buy, everything that they feel like buying. Yes or no? As a result, demand might increase than supply. Did you get the point? If the economy is growing, a lot of people would have their income. Well, that means a lot of people have access to buying whatever they want to buy. So the demand in the economy will rise. And if the demand in the economy rises above the supply in the economy, inflation will occur. Do you get the point? Businesses, firms, suppliers will reduce the quantity sold in the market so that they can increase the price to maximize revenue and profit. So inflation will occur. So an economy that is growing too fast might witness inflation, rise in prices of goods and services due to an increase in demand. Is it clear? Is it clear, please? The environment. They said environmental groups believe that the benefit of growth are lower than the cost of generating that growth. So for example, as economy grows, more cars are purchased and more flights are taken. Both car and air transport contributes to greenhouse gases, which cause global warming. In some countries such as China and India, very high levels of pollution have accompanied high levels of economic growth. Also, economic growth uses up non-renewable resources, such as, so here, we have to think about sustainable growth and unsustainable growth. But most of the time, when we talk about economic growth, it comes with a price. The price is how pollution and resources depletion would affect the future. Do you get it? Economic growth will not come without you using resources. Do you get it? Economic growth will not come without you using resources. So when you continue to use resources will finish. So that's why they said environmental groups believe that the benefit of growth are lower than the cost of generating that growth. So yeah, it is good for the economy to witness growth. But what are the consequences of growth? These are the consequences of growth. One, pollution. If a lot of factories are here producing, it means Libya will have a lot of output, but at the same time, a lot of pollution. This is the problem about China and India. They have a lot of manufacturing industries. The Indian economy is growing well. At the same time, the pollution in the economy is increasing. Do you understand? Another thing is that because you are witnessing economic growth, it should have meant that you are fully utilizing your resources. One day the resources will finish. Then where is the sustainable development? So businesses, firms, when the economy is going, they are using up resources, which means the future generation might be having problems getting resources. That is the point. Is it clear? All right. We have activity, we don't need those activities. And that's all about chapter 25. So we go to chapter 26, inflation. So when we talk about inflation, inflation is the persistent rise in the prices of goods and services in the economy. So let's see what they said. Yeah, inflation can be defined as a general and continuing rise in prices. I said that already. So yeah, it says sometimes prices fall over time. In getting started, the price of petrol for Julian, okay, we don't need this one. Let's just go straight to other place. Okay, so the point we need here, it says deflation. Deflation is the term used to describe a falling. So there's inflation, there's deflation. When you talk about deflation, it means a fall in the price, in the average price of that economy, in terms of goods and services in that economy. Then we have aggregate demand. When we talk about aggregate demand is the total demand in the economy. Aggregate demand is the total demand in the economy. So I'm seeing what we need here. Okay. Yeah, they said government usually measures and monitor the rate of inflation. In the European Union and many other countries, inflation is measured using the Consumer Price Index, which is CPI. The CPI is a measure of average prices calculated from the same price information. Every month, the government records the price of about 600 goods and services purchased by over 7,000 families. An average monthly price is then worked out from all the information gathered. So this average price is then converted into an index number. This allows comparisons to be made between two different periods. So the CPI is the measure used worldwide and is the measure used in figure 26.1. So for the CPI, how do we use the CPI? We measure the market, the basket of goods and services. There's a basket, food basket. That means where a basket is not just that basket. We're talking about the things an economy sells. The things consumers purchased within an economy over a period of time. So the total of what they produce or what they consume is always put or placed in the food basket. So consumers, they buy food, they buy clothes, they buy petroleum, they buy all these things. So all these things are put into the food basket and they are measured using the CPI. So we're going to have, let's see what they have here. I didn't talk much about it. So for the CPI, you measure it based on the price that you've been given and the quantities of goods you have. That's how you measure your CPI. Then we go to the types of inflation we have. For the types of inflation is the same as causes of inflation. When they say, what are the causes of inflation? We're talking about the types of inflation. So what are the causes of inflation? Number one, demand pull inflation. Are you there? So when you talk about demand pull inflation, this is as a result of increase in the aggregate demand in the economy. If demand pull means the economy is witnessing inflation because a lot of consumers are demanding for goods and services. So because the demand is increasing, firms increases the prices. That is demand pull inflation. Do you get demand pull here? Demand pull inflation is as a result of increase in the total aggregate demand in the economy. So the demand is increasing in the economy, then prices are increasing. That is demand pull inflation.
What about the income?
If income is increasing.
Income is increasing at the same time as the demand and prices are increasing.
No, yeah, if income is increasing, it would lead to increase in demand. Then the increase in demand will lead to demand pull inflation. So increase in income would have been as a result of economic growth, which is as a result of increase in the employment rate. So increase in employment rate will increase income. Income will increase aggregate demand. And increase in aggregate demand will lead to demand pull inflation. Is it clear? Then they said, what are the causes of demand pull inflation? Number one, rising consumer spending encouraged by tax cuts or low interest rates. Demand pull inflation could be as a result of reduction in taxes, in income tax. So if income tax reduces, it increases disposable income. That means people will have a lot of money with them to be able to spend. Demand will rise. If government reduces interest rates, what is interest rate? The price of saving or borrowing. So if government reduces interest rate, it means that people would be motivated to borrow money from the bank. Then people would have a lot of money to spend. That would cause demand pull inflation. Two, sharp increase in government spending. If government continues to subsidize things, government spends on education, government spends on health, this will make that things become cheaper. As a result, demand will rise against supply, which will lead to increase in price. Rising demand for resources by firms. There could also be demand pull inflation if firms continue to demand, or if firms continue to get resources. We need raw materials. They continue to get raw materials. Price of raw materials will rise. Not only consumers here. So firms, businesses also need demand. They demand for components. They demand for raw materials. So if the demand for raw materials increases, it could lead to demand pull inflation. See what I'm saying here? For consumers, rising consumer spending will lead to demand pull inflation because consumers have increased what they demand for. For firms, when they continue to demand for more resources, more raw materials will rise. That is what we call demand pull inflation. The booming demand for exports. If an economy witnesses increase in exportation, that means goods are going out of the economy. That means goods will be expensive in this economy because businesses are selling abroad. They forgot about the local customers, the domestic customers. They don't want to sell. They don't want to sell locally anymore. They want to sell internationally because of what they earn. So this could lead to demand pull inflation. Do you get it?
Yes, I get it.
Okay. Another type of inflation is cost push inflation. For cost push, what does cost push mean? It means prices of goods have risen. Prices of goods are increasing as a result of the cost of production. Are you with me, please? If the cost of production increases, the cost at which you produce as a firm increases, you have to increase the price. This is cost push inflation. Do you get the point? The cost of production has increased. As a result, prices are increasing. That is cost push inflation. It could be wage. It could be that employees are asking for more wages. It could be that the cost of raw materials has increased. As a result of this, businesses want to increase their prices to be able to make profit. Do you understand? This is what we call cost push inflation. Do you understand cost push here? Demand pull is as a result of increase in aggregate demand. Cost push is as a result of increase in the cost of production. Is it clear?
Yes, all of this is like connected together somehow.
They are all inflation,
Yeah, it's all like inflation.
but they are different.
But
The
they're
difference
connected.
is what?
They're connected, but they're different.
They are connected in terms of rise in price, but they are different because one is as a result of increase in demand. The former is as a result of increase in demand. The latter is as a result of increase in the cost of production. And I think there's another one. We have the case study here. So now we go to the relationship between inflation and interest rates. For inflation, we already said inflation is the persistent rise in the price of goods and services in the economy. And for interest rate is the price of borrowing or price of saving. So what is the relationship between them? Okay, here they said, another theory of inflation is held by a group of economists called monetarists. Monetarists believe there is a strong link between inflation and growth in the money supply. And growth in the money supply. The money supply is the stock of notes and coins, bank deposits, and other financial assets in the economy. This is explained, okay? Inflation may be caused when household, firms, and government borrow more money from banks to fund extra spending. This adds to the money supply because there are now more bank deposits. The borrowed money increases bank balances. The extra money lent by the banks creates more demand and prices are driven up. This type of inflation is more likely to happen if interest rates are low. I told you earlier, if the interest rate falls, a lot of people want to borrow money from the bank. That means money supply in the economy will increase. Do you get the point? If interest rate reduces, that means the prices at which you have to pay for borrowing money reduces, then you'll be encouraged to borrow more money. Do you understand? That means a lot of money will be in supply in the economy. So, here they said, this is because borrowing is likely to increase when interest rates are low. So, what are the impacts of inflation? One, on price. One of the main problems of inflation is that prices are rising. As a result, inflation reduces the purchasing power of money. So, if inflation rate is increasing, money becomes powerless. So the $10 you have today would not be enough to buy the goods worth of $10 tomorrow. So if this laptop is $10 today, due to inflation, the laptop might increase to $12. So that means the $10 you have saved today won't be enough to buy the laptop tomorrow due to inflation. So inflation reduces the purchasing power of money. Do you get the point? With inflation, people won't have the ability to use what they have to buy what they need. So if you have $10 today, if inflation happens, the $10 of today would not work the $10 tomorrow based on what it would be able to buy. That is what they're talking about here. Two, wages. When prices are rising, workers need to increase their wages to compensate for the loss in purchasing power. So another problem about inflation is that wages, workers will demand for more salary because they want to keep up with what they used to buy. Inflation would make them not to be able to purchase what they are used to purchasing. As a result, they will demand for more salary from their employers, which is a problem for the employers because their cost of production will rise. And that might make businesses or employers to increase the price of goods or services. You get the impact of inflation here?
Yes.
The first one is on the price. Prices will rise when there's inflation. As prices rises, the purchasing power for money will fall because the value of $10 today will not be the same value of $10 tomorrow. So it will not be able to buy what it used to buy. The second impact is on wages. If inflation continues to increase in the economy, workers, employees would demand for high salary to be able to compensate for the loss of purchasing power because they won't be able to buy what they used to buy. So to be able to buy what they used to buy, the employers have to increase their payments. Is it clear?
Yeah.
The third one, exports. If inflation is higher at home than in other countries, firms will find it difficult to sell in overseas countries or overseas markets. If inflation rises in Libya, it will be difficult for Libya to export its products out of Libya because the product will be expensive. So if inflation is increasing here, it becomes difficult for a business here to be internationally competitive because price of goods produced here will be high. Is it clear? Exports. Export means you are selling to foreign customers. We talked about that yesterday. Export means you are selling to foreign customers. So if in the course of you selling to foreign customers, here there is inflation. It means the prices at which foreign customers will buy will rise. They might be discouraged to buy from you. So they will be discouraged to import from your country. So you won't be able to export to other countries because the prices in this country is increasing. Is it clear? Unemployment. If inflation increases, demand in the economy will fall. As a result, businesses will witness less revenue, a fall in revenue. And if businesses witness fall in revenue, they might want to reduce the number of workers they have. Do you get the point here?
Yes, I get it.
Inflation would lead to unemployment. How? If there's inflation in an economy, if inflation is increasing in an economy, businesses will witness a fall in their revenue. That means they won't be selling as they used to sell. As a result, they would want to reduce their cost. And in the course of reducing their cost, they might need to disengage some workers. Then unemployment will rise in the economy. Is it clear? Menu cost. When you talk about menu cost, it means because of inflation, every now and then, businesses will have to change their price tags. Today, they have a price tag of $2, and there's inflation. They want to rip it off, put another price tag. It's expensive because they have to start paying for materials they use. The paper is expensive too. That is menu cost. Do you understand? So businesses have to continuously change their price tag due to inflation, which increases their cost. Is it clear? Shoe leather cost. Another problem, another impact or another problem of inflation is shoe leather cost. It means every now and then you would want to move as much as possible to bargain for a good price. So you move from one shop to another, from one shop to another to get a better price. That is shoe leather cost. Do you understand? Shoe leather cost means you have to continue to find a business that will sell at a lower price for you. So when you go to one shop, they say it's $10 here. You want to go to another shop to check if it is $8, if it is $9. So you continue to move. That is shoe leather cost. Is it clear? Uncertainty. With inflation, businesses lose confidence. Things are not clear. You wouldn't know what could happen tomorrow. Do you understand? If there's inflation in an economy, businesses, consumers they don't know what could happen tomorrow. So they lost confidence in economic situation. So they don't know when to invest and when not to invest because of inflation. Is it clear? The next one, business and consumer confidence. Yeah, okay. Let's go back to uncertainty. For me, yeah, they said uncertainty. Okay. Yeah, you wouldn't know the prices at which you sell. Another problem about inflation is business and consumer confidence. Businesses would be scared to invest in the future. They want to sell as much as they can now. They don't want to think of research. They don't want to invest in things because prices are high. Consumers, when there's inflation, they lose confidence. They want to buy at any point in time. Maybe the price will even rise tomorrow. They are not sure about what the price will be tomorrow. So they lost confidence in the economy. That is because of inflation. Then investment. What happens to investment when there's inflation? If inflation increases in an economy, investment will fall because people won't have access